Okay, I don't want to hold everybody up. So thank you for getting on this meeting. For all the realtors here, obviously, you know me. I know that some of the realtors kind of took that extra step to get their buyers on this webinar, which we are happy to have people do. I am recording this so we can get it out to other people if we need to. But I'm Shaughnessy Narth. I'm the president and CEO of Excel Realty and Mortgage, and wanted to get on this meeting because this thing is extremely important. It is a program that we haven't seen before at all. There's down payment assistance programs that have been around for a long time. There's some that come and go. This one is very, very different, and it's going to allow a lot of buyers to purchase in California, for a lot of different reasons why they're able to purchase more with something like this, just because of the down payment assistance. But not only that, there's all kinds of other things that we're going to go over, what makes it so important for a buyer. So on the meeting, I have Nick Minio, and Nick Minio, I know a lot of you already deal with him on the lending side. So he is my right-hand man on all of my loans. He's been with me for over 6 years as a full-time loan officer here. He's extremely knowledgeable. He does a lot of these type of deals to begin with. We are approved with over 60 different lenders. And so what makes us a little bit different is that we're always looking at what else is out there. And so if your buyer comes to us and says, hey, we want to get approved, I want to try to get approved for a little bit more. Well, we have different programs that may allow a little bit more, or maybe a better rate, and maybe it's a little less, or maybe it's a combination of all of the above. So that's something that makes us a little bit different than other lenders out there. And then also being a mortgage bank ourselves, that helps out a lot as well, to make sure we're getting the best rates, lowest fees, that type of thing. So without further ado, so this is a CalHFA program. And a lot of people think that CalHFA has something to do with the FHA because there's the same combination of letters in there, I guess. It does not. It is a standard lending program. So it's a conventional lending program, which is a big deal because with FHA loans, there's mortgage insurance. There's what's called upfront mortgage insurance and monthly mortgage insurance. And that's rather hefty on a buyer or a borrower. So this program, if you're putting down the 20%, there's no mortgage insurance on it. And the 20%, again, is coming from this down payment assistance. So let's get into it. So it's 20% down. You can do less than that if they wanted to. If the buyer said, hey, I only want to use 10% of the funds from the CalHFA, that's fine as well. Even if somebody's putting down 10% already, or 20%, or even 30%, they could also add in this 20% down payment assistance, which would really help with their purchasing power, because they could have as low of a loan to value of 50% if they were putting down their own 30% and then getting 20% from this down payment assistance. So there's just a lot of options with this. Let me silence my phone here. So the way that it works is that they're going to share in the appreciation, and we're going to go over all of that. But that's the crux of it. They're going to give this money. There's a certain amount of it out there, and there's no payment on the money that they're giving you. There's no interest on the loan that they're giving you as well. So let's go through it. Okay. So again, they call it the dream for all. And I was just showing Nick this, that, you're going to see this in the news everywhere on Friday. I saw it on just NBC News. Buyers are going to start hearing about this. This is really the time to reach out to your database and see who you could get to move forward on purchasing right now, because it is a limited time offer. And I've been saying this multiple times because I've been talking to a lot of people over the weekend about this. That's not a sales pitch of some sort. It is a limited time offer, and I'm going to explain why. So the down payment assistance, again, it's up to 20%. It's a second on the, with the first. So there's a first loan, there's a second loan. The second loan has no interest on it. It has no payment on it. There's $300 million that CalHFA has put aside for this program. So once the funds are gone, they're gone. Now, originally, I will tell you, knowing a little bit about this program, some of the behind the scenes stuff, they were originally going to put $500 million into this. And for whatever reason, they changed it to $300 million. So hopefully at the end of this, there's some extension. They maybe add some more funds into it. Maybe they see how it goes with the $300 million and that type of thing. But basically, there's only a couple different things that a buyer has to be. They have to be a first-time home buyer. That's the first thing. But again, it's very different than other first-time home buyer programs, because technically someone could have an investment property that they currently own and they're not living in it. They just are renting it out. Well, if they are renting their own home or living with somebody or whatever they're doing, as long as they don't own a home that's their primary residence, then they're a first-time home buyer. It's also one of these things that if you purchased in the past, but now you sold 3 years ago, or you've been renting for the last 3 years or whatever, you are considered a first-time home buyer. So it's just 3 years of not owning a property where you are living in the property as a primary residence. The other thing is, even if you helped out, a family member, your parents or whatever, with a purchase and you don't live there, let's say you live in San Francisco and they live out here in Pleasanton, and you help them out with the loan. And there's a lot of people that do that kind of thing. And so if they're not actually living in the property and they didn't make the payments on the property as well, then they're considered a first-time home buyer. So there's a lot of latitude there. Okay. So the income part of it is where it really gets just so different than any other first-time home buyer program. So the income usually on first-time home, on down payment assistance programs, there is like real limitations on the income that the person has. Well, in this program, what makes it so different is that the standard income that they use is so much higher than a normal program. It's incredible. So like for example, in Alameda County, Contra Costa County, the income limitation is $282,000. So it is a huge amount of income that someone can have and still be considered for this program. And not only that, so basically it's base income. So normally on loans, we're trying to get more income for the borrower. We're trying to use their bonus income, their overtime income, or maybe in our area, there's a lot of people with RSU income, restricted stock units, that type of thing. We can use as much or as little as we want, basically. We have to use the base income. But if the person makes the $282,000 in base income, but they also make bonus income or commission or overtime or RSU, we don't have to put that down. That's part of the program, that it says that you are allowed to just put down the base income. So you can kind of stay under that mark for a lot of people if you need to. Now, again, it's a pretty high mark to begin with, and each county is different. So every county has a limit. And so Nick is going to easily be able to answer any of those questions of any county in the state. Now, I should have mentioned this to begin with. This is a state of California thing. So it's only California properties that are involved in this. It's not a national program. So the other part of it is credit score. So credit score, so technically it really goes down to 660 credit score, but it gets into a different area median income that the person has to be in. They have to be in a lower income to allow a 660 credit score. But 680 and above allows the standard income. So again, up to that in Alameda County, up to that 282,000. So it's a huge game changer there. And then above a 700 credit score, we can go up to a 50% debt to income ratio. In standard lending, really like a 43% is kind of standard lending. You can get up to 45 sometimes, but 50 is a huge difference for what someone can afford if they choose to. So, and again, I'm sure this is on the next slide, but if the borrower is putting down, let's just say they're thinking about doing a conventional program right now, and they're going to put down 5%. Well, their first loan would be a 95% loan to value. Okay. They'd be putting down their 5%, and then they would have mortgage insurance on that. Even on a conventional program, you're going to have mortgage insurance if it's not an 80% loan to value. So then there's going to be, let's say, $150 in mortgage insurance there that the person has to take into consideration on their debt to income ratio. Well, in this program, it is an 80%. If you're taking the full 20% shared appreciation, the down payment assistance, it's an 80% loan to value. That's what your payment is based on. Not only that, if you can go up to a 50% debt to income ratio, it allows a huge difference in the purchasing power for buyers. So, you know, a buyer might be able to go from like a $550 purchase price to a $700 purchase price with this program. It can be that big of a difference. And again, they can put down more funds if they choose to. Okay, so, and here's what we're talking about. So like the minimum combined loan to value, that is both loans, is a 70% loan to value. What that means is the borrower or the buyer could put down up to 30% of their own funds in there if they choose to, then get 20% of this down payment assistance, and they would have a 50% loan to value. So imagine going and writing up an offer and it's a 50% loan to value, because that's essentially what this is if the person put that much. Even if they just didn't put down anything and they were just doing the standard 20% down payment assistance, it's an 80% loan to value. It's kind of similar to if we were getting gift funds on a purchase. Let's say the dad is going to give the son 20% down on their deal. Well, it's an 80% loan to value. They're getting 20% from the dad. The buyer is not really bringing in any of their funds. Well, that's the same thing as this, because really the dad could change their mind at any time, and then you wouldn't have those funds available. Well, there are some limitations on this. So we have to obviously do the due diligence and make sure that the person qualifies for this and everything. But beyond that, it's a matter of getting things in and getting things done quickly. And I'm going to go over that. So the way that the shared appreciation, and Nick, is that going to be on the next slides? Do you know?
Yeah, exactly. Next slide will show that.
Let me see. Okay, good. So the shared appreciation, because this is a little confusing to some people. So basically, a good example is right down here where he put this down here. And Nick is the one that put together this presentation. Great job there, Nick. So a 500,000 purchase price, let's say that they're using the full 20% down payment assistance. So they're going to get 100,000 from CalHFA. He's saying 2 years later, they want to sell. Let's say it went up by 200,000 in general. So it's up to a $700,000 sales price on this. So basically, they're going to have 20% of the difference from the purchase price to what the appraised value or the sales price is at that time. That is what the CalHFA is going to get by doing this program. They're going to get, in this case, out of that 200,000 in the difference in equity from when they purchased to when they sold, or when they wanted to get out of this loan, because they can get out of it at any time as well. It is a 20%. And so that'd be $40,000 that they would get. Plus you have to pay back the down payment assistance, of course. So, you know, you'd be getting, they would be getting 140,000 back on this. So again, let's talk about that real quick. You can refinance this at any time. As far as there's two different ways. There's one where you can refinance this where, hey, Nick, what are current rates actually on this? Because I know they're very, very standard to what we would be providing on a conventional loan anyways, right?
Yeah, exactly. So for if we're using the standard income, so the maximum income rates today are going to be 6.125. And if you have a borrower who's at the 80% median income or less, that is 6% today.
So they're awesome rates because I mean, that's standard rates right now. And then the thing of it is that you can refinance this loan and keep the shared appreciation if the borrower chooses to. So let's say they have the 6.125 right now, and a year from now, rates have come down, which we absolutely believe they will. And we go, okay, we can get them 4.875. Well, at that point, you can refinance it one time, okay, during the life of the loan. So it's a 30-year amortization, same as any normal loan. But you're only allowed one refinance on this to keep the standard or to keep the shared appreciation part of it. If you choose to, though, you could go in a year, you could say, you know what, I want to get out of this shared appreciation. I don't want them to get any more of the appreciation. I just needed it to purchase. Maybe there's going to be another borrower that's going to come on the loan. They couldn't be on the loan to begin with or something like that. And now we're just going to go with a normal refinance. Well, you can refinance it, and then there's the appraised value that's done at that time, and then they'll get their shared appreciation, and you pay back the down payment assistance that they gave you and move on. And then it's just a normal loan. So there's a lot of different options with this. So impounds, go ahead.
Sorry, on that last slide, want to point out that the maximum of shared appreciation, it cannot exceed 2.5% of that original down payment they gave you. So if we're looking at that example, let's say they have $1 million in equity, 20% of that plus the down payment is $300K. Well, they wouldn't pay the $300,000 because that's over 2.5% of the original $100,000 that they got. So I just want to let you guys know that there is a cap on that.
Absolutely, that is huge. So thank you very much. Impounds. So yeah, you do need impounds. You need a home warranty on this. You must occupy it as a primary residence. Now let's just quickly talk about that. So I've talked to some borrowers over the weekend that maybe they go, hey, I can only afford a certain amount. Maybe it's not ideal for what I really want to be, like the rental house that they're living in might be nicer than what they are able to purchase or something like that, just because of their income or something. Well, if they live in it for 12 months, that on all standard lending, as long as if you are doing an owner occupied loan and you live in it for 12 months, well, after 12 months is where, like, if life changes and you don't want to live there anymore and you want to rent it out, you could rent it out at that point. So for a lot of people, and again, on an investment property, if somebody was buying an investment property, they pretty much have to put down 25%. That's kind of the standard in lending. And most people are probably putting down 30% on an investment property. Well, someone, if they were a first-time home buyer, could technically buy a home, live in it for 12 months, and then say, you know what, I'm going to go live somewhere else, and I just want to keep this house. Well, they could keep it and just rent it out at that point. As long as that was the idea, was to move into it as a primary residence and stay there for at least a year. That is kind of what in standard lending, this is what's allowed. So it's a huge deal. All borrowers, this is a huge thing. So people think that there's different rates. There's not different rates. Everybody has the same rate. Now, the thing of that is that there's very few lenders that have this. We happen to be one of them. And it's because we're approved with a lot of different lenders. And so there's only a certain amount of lenders that even have access to this program. And we happen to be one of them that does. So we work with even before this program started, we work with the largest lender that does CalHFA loans in California. And we have a very good relationship with them. We do loans with them all the time, of other types of loans as well. But so it's a good process. There's not really any negative side to the process of getting these type of loans. So let's see. Yep, there's U.S. citizen, but there's also the visas that are shown there, the HB1. There's all kinds of availability there, even DACA. So it's the standard loan limits like there is for Fannie with in every county in California. It's the 726,200, but the high balance conforming limit is almost $1,000,001 in Alameda County, Contra Costa County. So it's a large loan that someone can get. And again, they have 300 million that's available for this program. So you can do the math pretty quickly. If you're buying $1,000,000 home and you're putting down the 20% and getting that down payment assistance of the 20%, that's 200,000. They say, hey, it could last 6 months. We just don't know until, it depends on what the down payment is that people are getting and, how many buyers get on this thing right away. And I'm going to go over that. So as you see, the property eligibility, it's basically a single family residence, it's condos, it's PUDs. And then you can have one ADU on the property if that's, you can't have two ADUs on the property, which some of these have, but that's also a game changer there. Okay, now here's where you got to get running, basically, guys. And again, not a sales pitch to anybody. I've been telling buyers over the weekend, I've been calling a lot of people, talking to people, because I just feel like this is such an important program because it's a rarity and it's going to be gone, right? And so there are two things that the person has to do. They have to take a class, and it's $99. It's 8 hours. It's online and all that. Then there's a verbal counseling that they have to do. Well, here's where the issue comes in. This program came out last week on like Thursday. Well, it was already in the verbal counseling. The dates for them were already in April, middle of April. Now it's been a couple of days. I bet you it's towards the end of April. In another week, it's probably going to be into May before you'd be able to do the verbal counseling part of it. Now, you don't have to have that done before you go out looking for homes and you write up offers and all that kind of stuff. But we're suggesting all of our buyers get on this training now. They sign up for it. I had multiple people over the weekend sign up for it. They've already done the training, and now they're just waiting to have that verbal counseling. They'll get a certificate that's good for 1 year. So that's a huge deal. It really is a big deal, because imagine, there's going to be a lot of people out there wanting this program. The good news is that, well, not the good news, I guess, but there's just, obviously we all know that there's a lack of inventory in general in California. So that's the only problem right now, is that, hey, there's not that many homes on the market, but you really need to get your buyers on board right now. And there's a couple of reasons for that. For one, we know that interest rates are going to start coming down in May. And that's a whole nother conversation, but we know this is going to happen. And so May, June, July, August, rates are going to continue to kind of come down. The market's going to really heat up. Now, I always say when other people sell, it's kind of contagious, and other people like to sell when other people are selling. So, there may be more and more homes coming on the market, but the market's going to heat up. There's going to be multiple offers on homes. Once interest rates come down, everybody's going to want to get back in. Be ahead of the curve, So, okay, it's a 30-year fixed loan. Again, no prepayment penalty, no interest, no payments. Okay. So it's about as good as it gets, unless it was forgivable. That would be awesome, but it's not. So let's see. Income. So we already kind of talked about that, where, we don't have to use all of their income if we don't need to. Again, normally speaking, it's the exact opposite. We're trying to convince the underwriters that, hey, this bonus income is going to be there for the future, or this overtime is consistent, or whatever it is. So again, this is not something that, you get into contract. If you're getting into contract in August, there's going to be some serious problems with the funds being there. because the funds have to be there when you close. That's when they provide the funds. It's not like it's locked in and you get to say, okay, well, the funds are protected or something like that. It's not. So that's why it's so important that you get on this, like today, get on it, with any of your buyers. My suggestion for all you buyers, for one, that are on this, great to meet you. Nick Minio can answer all kinds of questions for you on the lending side. Our realtors are obviously awesome, and they're going to be able to answer all of your questions as well. But it's a matter of getting on this now, because it is going to be gone, and then you're going to miss the boat, and people are going to hear about it over and over. And then all of a sudden it's going to be harder and harder to get on these different, trainings that you need to do, or qualifications that you need to do, as far as the 8-hour training and the verbal part of it. The verbal part of it is going to be the thing that takes a long time. Let's see. So there is the contact information for Nick Minio. And so let's open it up. Actually, Nick, did I miss something? Give me some things that I missed already.
Let's see. I mean, I would just stress, it's a pretty simple process. It's really just a conventional loan. There's just those 3 basic overlays that we went over with the debt to income ratio and the income limit. But besides that, the underwriting process is just like any other standard loan.
Okay. Okay. And then I guess one other thing before I open it up to just any questions, and I see, Nick, why don't you, when we get ready for those questions, if whatever you've answered, let me know. If you haven't, throw them out there. So listing agents. Okay. So one of the things that makes us very different here is that when you write up an offer and you go send it to the listing agent, Nick's going to call. He's going to call the agent before they call him. And he's going to say, hey, this is Nick Minio from Excel. This is what the deal is with our borrower. This guy is great, whatever it is, right? He's going to be able to explain this program if there's that explanation that's needed. And that's going to be the difference of getting into contract or not. Honestly, it is one of those things that if somebody says, okay, it's 100% financing, they got offers that are 10% down, they might think that's better, or even 5% down, that might be better. It's really not at all. The only thing that can go wrong with these kind of loans is if the money runs out. That's it. So it's a matter of, it's not going to run out for, a couple months for sure. So it's a matter of getting on the treadmill and starting to run right now, because that's what this is going to take, is get to your buyers today, talk to them about it, get on the phone with them, explain what the program is and why it's so beneficial, and then get them over to us. I guess that's the other thing is, you're not a loan officer. You don't need to be. Just get them over to us. And again, we're approved with 60 different lenders. We have thousands of programs. I mean, literally thousands of programs. And I'm not using literally the way my kids use it, where they say, literally, I'm going to die, and they are not literally dying. So it's one of those things. So get them over to us, and we will help them determine what programs are available and just make the process as easy as possible. All of our online links and all that kind of stuff for the lending application is super simple for people to do. It's one of the best applications that there is on the market. So it makes it very easy for people to fill out and everything like that. Okay, open it up to questions. Go for it. What do we got, Nick?
So we addressed some of these in the chat here. And this is a good question. Romeo is asking, what happens if there's negative equity when you sell the house? How would you repay the down payment assistance?
That part is interesting. I will have to find out about that, unless you know, Nick, because I don't know that part of it.
I know that. I mean, if they were, we need to confirm that. But if they were to refinance, I know CalHFA allows up to that 105 LTV, so they can still refinance. But we'll have to confirm that one for you.
The good news is we can easily show your buyers through systems that we have. When we are dealing with your buyers, we pay for a lot of different systems that make it to where we can show them the appreciation models that are going to go on. And the reality is that it's the going down in price. I mean, there are obviously some areas, still San Francisco is kind of one of them and everything like that. But most areas, I mean, they stopped going down a long time ago. It is the opposite way right now. We're getting multiple offers already again on properties right now. And it's because there's few properties out there, but this is even at a high interest rate, right? As soon as interest rates come down, it's going to be the exact opposite. Home pricing is going to go up a lot very quickly because of that. So as soon as interest rates come down, okay, now you get multiple offers, bidding wars start going on, the pricing goes up. It's a matter of act now. Go ahead. What else we got? We'll get back to you on that part of it because I want to know that myself.
Is the loan forgivable after 5 years? So
And
no.
yeah, I was gonna say it's there's not anything that I know of that's like that, Nick, correct?
Correct. And if they hold the property for 30 years and they pay off the first, then the second, that down payment assistance would be due payable at that point.